Dear learners, this is Shashi Ramachandran. Welcome to the third part of accounting terminology. In this video, we are going to learn about the term receipts and expenditure. These are the broader terms, and also we'll learn their types. So let's begin. Receipts. The amount which is received or receivable by the business entity is called as a receipts. Now, received means the amount which is received for by sale of goods or by selling the old furniture or by scrap or interest received, rent received, commission received. Receivable, that is to be received. So amount, that is what called as a receipts in accounting. Now this receipt is divided into two categories, that is revenue receipt and capital receipt. Now, revenue receipt is a one which is the receipts which are received by the business entity in a normal course of business. Means normally, usually what they receive, of course, they receive sale amount, sale price. Like sale of the goods is a normal receipt for the business entity. So, sale of a goods is one of the example of revenue receipts, and this is like other than this, like commission received or some investment if business has done, so they receive interest on that. If for the time being they have given their go down for a rent, then they'll receive the rent. So that all is an income, or you can say revenue for the business. So that is revenue receipt, or you can say it's of a regular nature. And capital receipt is, on the other hand, is something which actually is like which is not in a revenue in nature. So the capital receipt is an amount which is either increases the liability or it reduces the asset. Okay, so capital receipt means any amount which is received as an investment by the proprietor, or any amount which is received by the outsider, you can say the raising loan or investment by the public. So that is all capital receipt. So they are not regular in nature. They actually are not earned by the business. Okay, so that's an investment, so it increases the liability. On the other hand, the sale of fixed asset, again, which is non-recurring in nature. So the amount which is received by selling the old fixed asset reduces the asset, and it's not a proper or a regular earning of a business. So they are termed as capital receipt. Revenue receipt is actually, in general term, we'll call it as a revenue. So revenue is the amount which is received by sale of goods. Now we have expenditure on the other hand. Expenditure, in a broader sense, whatever amount is spent by the business entity is called as expenditure. Whether amount spent on purchase of fixed asset, or amount spent on payment of salary, wages, buying a building, payment of rent, okay, advertisement expenses paid, or telephone charges paid, fine, or buying this machinery bought and amount paid. So all this amount which is paid or given by the business entity is called as a expenditure. This expenditure is also classified into two. One is a revenue expenditure, another is a capital expenditure. So, as the name says, revenue expenditure is the one where the payment is done and the benefit is also availed by the business in the same year. Here it is enjoyed, the benefit is enjoyed by the entity in the same year. Say when the salary is paid, of course, salary is paid at the end of the month. So, 1 month first you have taken the benefit and then you are paying. So, that amount which is paid will not give you any benefit in future. You already have availed. So, the benefit is exhausted by this time. So, that is what called as a revenue expenditure. So, you can say that benefit extend up to 1 year. Like goods purchase, they are meant either for sale, or the raw material will be converted into like will go to the process of production. Payment of salary, rent, advertisement, any such type of expenses where the benefits are exhausted within a year. Capital expenditure, on the other hand, is something which is basically you can say the expenditure which extends more than the more than one accounting period. The payment is done, but the benefit is not exhausted in within a 1 year. In fact, the benefit you are going to avail for more than 1 year. So purchase of computer, land, machinery, or the money, this is all your capital expenditure. So even the money which is spent on the installation of a plant and machinery, I'll give you an example for this. Like the wages are paid to the laborers, those who have brought this machinery to the business firm. Transportation charges paid for bringing the machinery from the factory to the business firm. So that wages paid, that labor's amount paid, that all will be again added to the machinery purchase. So this installation charges when you purchase a new machinery, and like to install that machinery, whatever charges are paid, that also will be added to this machinery only. So that is also your capital expenditure, because we'll make it as like the amount paid on the fixed asset for installation is added to that fixed asset only. Okay, so I here it's revenue expenditure and a capital expenditure is distinguished. Now, revenue expenditure is termed as expenses, and capital expenditure you already read in my previous video that capital expenditure is nothing but assets. So, as an expenses and asset, we can say these are the terms which are used in the business accounting. That is when we write the accounts. But expenditure, revenue expenditure, capital expenditure, basically these are the theoretical word. Okay, and this distinction is required for preparing the final accounts of the business. So, in normal course, we'll be calling it as a expenses or assets. So, in the next category, it is deferred revenue expenditure. Deferred revenue expenditure are by nature revenue expenditures only, but where the revenue expenditure is huge in amount and is likely to accrue to the firm over a period of several years, then it is termed as deferred revenue expenditure. Means the amount is to be the benefit is to be availed in several year in future. Then of course we cannot take it as a revenue expenditure, we'll be taking it as a deferred revenue. Means the part which is going to give you benefit in future will be taken as a deferred revenue expenditure. Let us understand this with the help of an example. Suppose a Maruti Suzuki Limited spent 50 lakhs on advertisement to launch its new model of car, Maruti Desire, and it hopes that it will yield benefit for 5 years to the company. Now 50 lakh on advertisement, basically advertisement is expenses, other revenue nature expenses. But the amount, if it is huge and also it is going to give the benefit for next 5 years, so it will not be justified if we take entire 50 lakh amount as an expenses and show in one accounting year. So of course it will not give you a true picture of profits. So it's better that only the part which actually where the benefit is availed, exhausted during the year, that part should be taken as an expenses, and the rest of the part should be shown as an asset. And this type of asset is like this type of expenditure is called as a deferred revenue expenditure. So 1/5 part of this will be 10 lakh and 4/5 part 40. So this is the one which is actual expenses for this year, and the remaining will give the benefit in future. So this part, so here the one which is giving going to give the benefit in future is termed as deferred revenue expenditure. I know you can recall from my previous video, we also termed it as fictitious assets, the one which is fake in nature, fake assets which are revenue in nature, and will be shown in the like as an assets just because it gives the benefit in future. And this amount of 1/5 will be called as expenses, and this is going to be the part of expense a list, means that the benefit where the benefit is exhausted within a year. So let's recall. So hope you like this video. Share this video with your friends and do subscribe to my channel Exuberant Learners. Also click on the bell icon to get the latest updates on my channel. Thank you.